Hello, this is John Cavalli, and this is your February 2015 Financial Planning, Economic, and Capital Market Review. I'm glad you're with us. Thank you very much, and we'll get started. We're finally getting a day here with some sunlight so I can do a good video. I'm going to move right to the blog post that this is in. Thank you again. All right, here is the post for this month's video, and this is a good one. Of course, I always think this is a good one, but anytime we can save some tax dollars, I really like to jump in. The neat part about this post, and I'm reminding us, I mentioned a little bit about this in the fall, but the neat part about this post is that I'm reminding us of tax ideas that we can do today that will save our taxes for last year. So that's what we're settling up right now. By the way, the tax, most across the board, tax forms have been late this year. Fund that HSA. If you have a high deductible health plan, you want to go ahead and fund the HSA. I've put the limits here. Fund it for more than you're going to use. If applicable. I like to have folks fund this to the max, even if they don't use it, because it is a tax-deductible plan. The second possibility is if you have some income from, think consulting, think non-W-2. The most important part of this is it's non-W-2 income. Maybe you got paid for something directly, a consulting job outside of work or something of that nature. You can set up a SEP. It's called a SEP IRA, but you can set up a SEP and deduct up to 25% against this. So the neat part about both of these plans is that we're actually reaching back last year and keeping Mr. Uncle Sam, the silly picture, keeping him out of our pocket. All right. Moving on, I haven't talked about this in a long time. It's been interest rates. And this is something from Factset, that we have the highest forward PE ratio since 2004, and that's 10 years. Much of this is because the energy companies, their earnings have been down dramatically. The problem with this is that earnings are really kind of the mother's milk of stock appreciation. And so all other things being equal, this is earnings, and we'll see, the markets bounce around a little bit. But when this turns over and starts down, and this continues up, this spread can only last so long. Valuations are clearly stretched. That was what the Fed has wanted us to do. And I really think I'm going to talk about this more in the coming newsletter as well. I'm going to put in a couple of pieces in the newsletter that talks about multiples and where we are, because this market, capital market, has been such a momentum-driven market, and I'm worried about a sharp pullback. We're watching this, needless to say. I say right here, we're certainly watching this because ultimately this cannot continue. Let's see what happens if this turns, if this flatlines somewhere, somehow, this variation, as it can only get so far here, it can only get so far here as well. Well, we hope you like February's economic and financial planning and tax review. Thank you as always. I hope that you have subscribed to our YouTube blog, our YouTube channel, and we'll talk to you again in a month. Thanks again. Bye.